Welcome, everyone. I'm Ted Earhart. We're going to talk about mortgage rates today because you've probably heard that they're sitting at all-time lows. But I'm going to propose the question, should rates be even lower? This is especially important because there's a key interest rate relationship that suggests right now the answer is yes. And without question, there's a lot of folks in the United States that probably have a pretty low interest rate already. They're feeling good about that. Maybe you got a 30-year mortgage in the upper threes or lower fours, and you're wondering whether or not it makes sense to pursue refinancing to save a half a point, for example. I think if you follow along today, you're going to see there's probably a pretty good case to be made to be patient and see what happens in the coming months. So let's unpack this. We're going to start with just a little tutorial on interest rates, and I'll try not to go too deep for the sake of time, but it's important to kind of understand how rates are set. So first and foremost, the most important interest rate probably in the world is the rate on the 10-year U.S. government bond, which is also known as the 10-year Treasury note. This is generally considered the risk-free rate of return. So if you're a bank or even an individual investor who wants to lend money out and earn a return on that, you want to know what the risk-free rate is because you're comparing all other investment options against that. For example, if we go back to the early 1980s when you could get over 10% on a government bond, why would you want to risk your money in some risky company at 8%? It wouldn't make any sense. You could earn 10% on a guaranteed basis. So that 10-year government bond, again, which is considered the so-called risk-free rate, really serves as the benchmark for all other investments. So we can take a look at this. For example, now we're definitely not in the early 1980s. In fact, the situation is the complete opposite. If you look up at the screen, and let me try to get my pointer, this bottom line is the 10-year Treasury note. And most recently, when I put this chart together, far from 10%, the 10-year government bond right now most recently was sitting at about 0.64%. So if you lend money to the federal government for 10 years, you're going to get 0.64% on average. If you want to earn more than that, you have to start taking some risk. And that's why I have this benchmarked against several categories of companies based on their credit profile. So just for example, a AA rated company, which is one of the highest credit ratings, a company that's AA rated today, I think is Walmart. They can borrow money, very low rate, 1.85%, but it's significantly higher than treasuries. So the point is, all you really need to know is the 10-year serves as this key benchmark for everything, including mortgages. So when the 10-year is very low, other rates follow. We can take a look at the relationship between the 10-year government bond and the 30-year mortgage over the last 20 years for some context. Now, mortgages are kind of interesting because in the U.S., many ultimately, in fact, it's over half, end up being guaranteed by the government and sold to investors. So at the end of the day, they look a lot like a government bond and trade a lot like a government bond. And you can see how tightly the interest rates move together. But as an investor or even folks in the mortgage industry, what we pay a lot of attention to is the difference between these two interest rates, also known as the spread. And we have that charted on the bottom. So the current spread or the difference between the 30-year mortgage and the 10-year government bond is about 2.63%. But here's the most important thing. Over the last 20 years, the spread has averaged only 1.8. So as you can see today, the spread is abnormally wide. If we were to apply the normal spread or the average over the last 20 years, which you can see holds true most of the time, that would suggest the 30-year mortgage right now should only be about 2.5%. So given this relationship, which is key, mortgages, although they are at historic lows, aren't such a bargain in the context of this relationship. So this would certainly suggest if government bonds treasuries, the 10-year treasury, if it stays in this range in the months ahead, it seems like there's a fair probability that we will see mortgage rates continue to trend down and this spread normalize. That's certainly not guaranteed, but the most important question is, where do treasuries go? And I think it's probably likely that government bonds stay in these low levels because the Federal Reserve has taken, gigantic actions to put rates low in an effort to support the economy during this turbulent time with the global pandemic and so forth. So at the end of the day, this spread is absolutely key, and it is an indicator that mortgage rates very well could trend lower. One of the things that's being cited as holding the spread wide is just the sheer volume of refinance applications in the system today, and which has been true for the last 2 months. Because everybody has heard mortgage rates are at all-time lows, they're all rushing to refi at the same time. So banks have not had much incentive to lower rates. People are willing to borrow even with this spread abnormally high. So as this huge onslaught or this huge volume of refis kind of process their way or work their way through the system, chances are that if that kind of ultimately wanes, banks will have more incentive to lower rates, and we could see spreads kind of normalize, of course, depending on what happens in the broader markets. So that's a little bit about interest rates and mortgages. I think if you are in the market for a potential refi, this is something you want to pay attention to. And it seems like there's actually a fairly good possibility that we'll see mortgage rates in the 2s in the not so distant future. So thanks for tuning in. If you have any questions, feel free to make a comment. I'd certainly welcome that. And if there's any other topics that you're interested in hearing about, I'd suggest you put those in the comments section as well. So thanks for watching, and we'll see you next time.